So we'll get going and welcome everyone to our September quarterly webinar. For those that have joined us before, what we like to do in these sessions is to look to discuss and debate some of the issues facing the retail sector. As you'll have seen from the invite, historically, we are about to enter what we've known as the golden quarter. We continue as a sector to face some of the biggest challenges, and I know for a number of people I've been speaking to over the last week, some of the unexpected changes are definitely adding to the weight of the decisions that businesses are having to make. But what we hope to do today is to give you an insight to what we're seeing, some of the things hopefully that you can take away and think about that will help with some of the challenges and make those challenges into opportunities. So on that point, what I'd like to do is to pass to Sophie, who is going to take you through some of the current results from our High Street Sales Tracker. Thanks, Sophie.
Thanks, Laura. Morning, everyone. So just as a quick reminder of our High Street Sales Tracker, it looks at like-for-like sales on a weekly basis against discretionary spend categories and across three categories: fashion, lifestyle and homeware. I just want to remind you that it's free to subscribe. So if you don't subscribe to it already, by subscribing, you get this in your inbox every Friday for the week before, and then at the month end for the whole month. And as a contributor, again, it's free, but you get more detail as a contributor, and you also get it on the Tuesday. So if you're interested in subscribing, please just let us know by email and we'll get you set up. So we all know that inflation erodes consumer purchasing power, and it certainly has a disproportionate impact on discretionary spend. It's becoming harder, therefore, to get the consumer to part with their funds from that reducing purse, and this is exactly what the tracker shows. And we also know that because of the volatility that we've seen across spending patterns, it's actually quite difficult to read some of the results because the benchmarks are not as consistent as historically they were. But what we can certainly see is trends, and we can see that the growth in consumer spending has substantially fallen since early spring. What it also reveals is, you can see from that blue line, the non-store like-for-likes. Of course, February and March, we would have seen it in negative because its benchmark last year was when it was the only channel there. But if you recall, pre-COVID, online spend was increasing by circa 15 to 30%. Yes, COVID accelerated that online spend, but we're now seeing it in negative territory. And again, this is a clear sign that consumer spending as a total is falling. When we look at this across different categories, can you move to the next slide, please? When you look at it, next slide, sorry. When you look at it across the three different categories, what is clear is that the most notable drops, can we have the next slide? Good. Most notable drops is in homeware, and that's that bottom line. And if you recall, homeware was the channel, was the category that was doing the best out of the three categories in lockdown, as people spent more time at home. But we've seen this really drop, and we saw quite a drop in August where it fell by 6% compared to the previous year. And again, perhaps that's not surprising because it is the bigger ticket items, and therefore it is where consumers will first cut back. Elsewhere, we're seeing reports that retailers are already ordering lower quantities, and you heard from Laura, we're on the brink of entering that golden quarter. So they're ordering lower quantities with that expectation as they enter into October than they would have done previous years. And That again isn't surprising, because with consumer spending falling, it's critical that retailers are managing their inventory and they're not tying up their working capital in unwanted goods. And we all know that they're trading on paper thin margins, so it's going to be very difficult for them to lower those prices further. We've heard this week, Next has cut its forecast. Boohoo has given a trading update, which is expecting sales forecast to drop by 10%. So the forecast, I'm afraid I'm not sharing much good news. But what is clear is that also, as we've seen previously as well, when it's dropping, the two most critical factors which will be for the consumer is going to be value and relevance. On the plus side, when we saw we were coming out of the referendum and the pound dropped, we did see that exports took a rise because British goods become cheaper to the overseas market. But imports, obviously, with the pound where it is now, it become more expensive. So it's really critical going forward, those two factors of relevance and value. And again, it's where the retailers sit in the middle, which are the ones that will be squeezed the most. So I'm going to leave it there and pass on to our next speaker.
Thanks, Sophie. So I'm delighted for the next part of this session to be joined by Nick Sharp, and I'm going to ask Nick to turn his video and join me. Nick is a relationship director at Santander, and I'm going to ask Nick to do his own introduction this morning. But what Nick and I are hopefully going to debate is sort of from his perspective, what the banking market is seeing as they look into our sector. So good morning, Nick.
Morning, Laura. Thanks for the intro. Can you hear me?
Yeah, I absolutely can. So Nick, give us a quick couple of minutes on who you are. Tell the audience who's joining us today.
Yeah, thanks. So I head up the retail and wholesale sector for Santander Corporates in London and the South East. So in addition to managing our client portfolio in those spaces and a small team, I also work on the bank's internal retail risk policy and generally support colleagues around the country whereby they may have sector transactions that we're looking to engage in, or existing transactions that we are working through challenges on. Just as a little bit of background about my employer, Santander, for those that don't know, I'm sure you all do, but Santander Corporate, obviously still growing its presence as a corporate bank within the UK, I would say. We have a full corporate offering, and you know, that growth story is kind of replicated in other countries where we have a presence, notably Spain, Portugal, Latin America, but also Germany, Poland, USA, also very strong markets for us. So I guess, you know, our differentiator in the market, or where we can add real value to retailers and wholesalers, is on that international piece, that, you know, connectivity, just by leveraging our presence in those countries and our experience.
Brilliant. Thanks, Nick. So I guess getting into our discussion, this is a sector that I would love not to say it, but we've faced numerous challenges over the last 4 years. We've gone from Brexit through COVID, and now we face not only the consumer spending crisis, but perhaps some of the impacts over the recent announcements in the budget. This current phase, as we go into the golden quarter, you know, our peak trading period, it feels like we're facing some different challenges. You know, what do you see as some of those current challenges? What are your clients saying to you around, you know, what they're seeing right now?
Well, firstly, thanks for not asking me to unravel the events of the last week, because I definitely don't have the answers to that. And I guess, you know, a few years ago, what we're going through at the moment, current challenges, probably described as unprecedented. But seemingly every year we have unprecedented events, and the term almost seems overused. I guess the main difference I see at the moment especially within the sectors that I cover, is, you know, the perfect storm that I see that's kind of developed, whereby, and you know, Sophie's just alluded to this in the opening, you know, rising costs, you know, utilities cost pressures are obviously very, very well publicised. Logistics costs that we saw, you know, impacted really in COVID, and that's, whilst we've seen some correction in shipping costs, we're still not down to levels that we saw in 2018, 2019. Also the impact on raw material costs, and that's down to supply chain issues that we've seen. And then in addition to that, you've got your labour cost rises, and now rates. And you know, in respect of borrowing rates, you know, this is at a time when we're still unwinding some of the measures that we put in place to deal with COVID. And whilst we do a lot of forecasting and scenario planning, I'm not sure that any of us back in 2020 were inputting 6% as our lending base rate. So you've got all these issues to deal with at the same time that, you know, is just shown in the graphs that we've seen. Consumer confidence is seeing a sharp and understandable, I guess, fall off. So I think, you know, having all of that to contend with, I think is a particular difference. I think the other difference to point out is just some of the speed by which some of these challenges have come around, which obviously limits the time which companies have to plan and react. You know, if we look at the start of the year, if I just think about currency markets, many clients obviously with some exposure in dollars, and where the year started and where we've got to within a relatively short period, 8-9 months, you know, it really, you know, that speed really can hurt businesses. It can also be an opportunity. But yeah, I think, you know, as I've alluded to, just the sheer number of issues that management teams are going to have to deal with at the moment. And I think I remember speaking to a client back in 2019, and we were kind of discussing what we thought was going to be a relatively stable or normal year in 2020. Obviously, it proved not to be. And the focus for the client and myself when we were going through our agenda really focused on ESG issues and how they could build that so that, you know, there's no downside risk of greenwashing, and really kind of embrace the kind of ESG kind of mantra within their company. Cybercrime was a huge focus, and it is. I think it's really underplayed within the sector, but whilst everyone's very busy, that's something certainly to raise. You know, omni strategies, Brexit, social media, you've got all of these things, and this kind of before the day job. So, you know, as I say, the main difference is perfect storm, but with so many different aspects for management teams to deal with, and seemingly less time to deal with them. So yeah, I guess what are we seeing from clients to deal with all this? I think there's a lot of lessons that teams have learned from 2020. I mean, in terms of speed, that was pretty much as sudden as you can get, and total lockdown of some retail operations where they're maybe not so strong online. But I think, you know, the lessons that were learned through 2020 can be applied to today, in terms of scenario planning, and, you know, having more than a plan A and a plan B. You know, really need to have a look at those kind of Armageddon scenarios and what options are available to you, and they're not always, you know, apparent, and that's, you know, that's okay. But that really is a trigger sign to involve your advisors, your lender, and early engagement, I guess, is key.
Thanks, Nick. No, I think that's really helpful. And yeah, the points that you raised there around scenario planning, the ability for people to move quickly when there are a mountain of things to deal with. We've always talked on these sessions around cash being king, and I think as we go into this continual period of challenge, we'd repeat that message to the audience. Coming out of the summer, one of the common themes that we're hearing is that just liquidity is one of the biggest issues, because a lot of people have stock perhaps that it is a higher rate than they were expecting to have, as trading has been probably unpredictable versus a complete slowdown. There's certainly some positive themes in the market, but as people are talking to their lenders, whether it be Santander or any of the other banks that they're partnering with, how can you communicate with your lender to work together around liquidity and having the right level of liquidity as you go through, when there are so many macro challenges that are affecting decisions from all parties at this stage?
Yeah, it's a really good question, and I've mentioned about early engagement, which I think is really key. Having early engagement with advisors, with your lenders, with stakeholders, generally will keep more options open, more options on the table. I think the main thing for myself within the sector that's really risen to the fore over the last couple of years is being able to articulate your working capital cycle, really break that down, kind of explain, and really on a timeline for lenders. It's really useful to be able to explain the terms in place you have with suppliers, the length of those relationships, if there's any concentration risks, why you're comfortable with those, etc. And then, as you say, cash is king. So you are following the cash through those cycles, and from a lender's perspective, I guess it can help identify where different funding solutions and how we can support. I think I think logistics in terms of cost implications, any delays experienced, and so a lender knows what issues have been dealt with, etc., and how you've managed those, I think is also quite key. But another thing to bring out, I guess, is margin protection. Again, Sophie mentioned about the squeeze on consumer at the moment. How confident are you in passing costs on to the customer? Why would these costs be accepted, etc. How much of that cost can be shared between your end client and yourself? So I think all of those things, to be able to discuss those with your lender or advisors is really key. And then it is really overlaying scenario planning. As I said, is plan A and plan B enough? Really looking at kind of stretching models to see those what if scenarios. It's quite thought provoking. And the last couple of years ago is that you shouldn't never really write out any potential. But yeah, the interaction, open and regular. I would also say not to jump to a solution too quickly. So keep the dialogue quite open and be receptive to different solutions and different ways of structuring things. But yeah, as I said, the early engagement and involving your advisors and seeking their advice where they may have been through this journey and applied different solutions for different sectors, I think is really key.
No, thanks, Nick. I think that's really helpful. And moving on to, I suppose, the area that is probably giving most of our audience some sleepless nights at the moment, with the fall in the pound and the predicted fall in the pound. Our sector, I think resilience is a really good word to use in this sector with the challenges that we've faced. And one of the things that I've really noticed in the conversations I've been having with all of our clients and people that we're in constant dialogue with is that people are not sitting there with their heads in their hands. They're thinking about how to adapt to some of these challenges. One of the conversations I've been having as I've gone through this week in particular is where we are with the pounds and the opportunities that gives us to the export and internationalization, which on the back of Brexit has perhaps taken a bit of a back burner, perhaps for some businesses. Nick, you mentioned sort of your reach to the international markets. How accessible do you see that? What support do you have available? What is available for people who are thinking about, right, we have a pound that has fallen significantly. If we can increase our trade in the US in particular, that margin erosion point that you just raised could be something that it's a quite solid mitigating factor to. What are your thoughts on that, Nick?
Yeah, I mean, it's true that the UK looks cheap at the moment. Being married to an American, I'm certainly seeing that with the influx of holiday requests to come to London. I mean, it poses its challenges from an M&A perspective in terms of having such a strong dollar, and some UK companies potentially looking a little vulnerable. But I mean, in terms of the growth story or international aspiration, I think the question can sometimes be, where do you start? It can be quite overwhelming, and with Brexit still being dealt with it as well, maybe companies are still working through that and maybe haven't had the time to look outside of Eurozone, etc. But I think, just going back to seeking advice, your lenders, and at Santander we run a number of events aimed at introducing clients and prospects to new markets, series of webinars, in-country kind of meet the buyer events, also bringing companies over to the UK, and I know BDO do similar series of events as well. So I think it's being alive to them, really making time for this part of your business and building out a strategy. And I guess the other thing that I know is available through the majority of lenders, I guess, but particularly Santander and the likes of BDO, etc., is when there are these events, and I'm sure people on the call have inboxes full of events to invites to various things, is to take advantage of some of these. And one of the main advantages that maybe have been lost over the last couple of years is that opportunity to network with other business leaders, other peers, maybe slightly different sectors, and just kind of understanding maybe companies that have gone into the US or had a couple of years in the US as an example. What challenges? How did they overcome them? What kind of model did they use? Did they go with a distributor first? Did they just use their online presence and build up some kind of understanding of their client market over there through organic growth? So I think using that kind of opportunity to have a dialogue with other business leaders is really key. I think the other point is, again, it's around planning. Sounding a little bit like a broken record, but just understanding your FX strategy and your cost to serve in these markets, I think is really important as well before you invest too much time in there. I think finally as well, post Brexit, I think we're not quite seeing it yet, but there is certainly intention and support from government. So reaching out to the Department of International Trade and seeing how they can help. Obviously run a series of events as well, and can be very useful in navigating those first steps.
Great. And we've talked about some of the challenges, Nick, but we are entering our peak trading season. It is a time for people to really focus on how they maximise in that quarter. Yeah. What tips have you got for businesses as they go through into this final quarter of 22 and we move into 23, where I hope when we have our retail forecast update in January, there is going to be a time for us to say, look, let's, the markets may be slightly more settled, let's move forward. But I'll hold that thought till January. But as we go forward from here, any final tips that you could share, Nick?
I think, customer being central to everything. And I think, the importance of brand, but being able to articulate, what you mean and why you are different to the competition. I think the other thing, and just alluding back to kind of lack of time that seemingly everybody has, or pressure on time, is that customer experience. And so whether it's online, whether it's in store, it has to be a positive experience, whichever way it is, and being able to deliver that customer service, kind of reaching out and developing the relationship, which obviously is a little easier with a physical presence, but online, there's not really the excuse if someone's made that purchase not to almost give them the excuse to return, whether it's loyalty schemes, whether it's referral awards, discounts for repeat business. But the customer's got to feel valued, and they've got to feel that they have value as well. So I think keeping the customer central and keeping the dialogue that you have with those customers, relevant and regular without being intrusive, is going to be really, really key at a time when, especially with discretionary spends, you're going to have to justify why they're going to part with their pound. So I think, nothing new there, but it's just a reiteration of making sure that when a customer has made that transaction with you, thank them, invite them back, show that they're valued.
That's really helpful. Nick, thank you for joining us this morning. Really appreciate you coming on with us. And for the audience out there, I forgot to mention at the start, we will have a final Q&A session at the end of the presentation today. So if you do have any questions, do post them into the Q&A function on the system. And with that, and with thanking Nick for his time, I'm going to pass over to James, who is going to take us through perhaps some of the things that we see that you can proactively be doing, those priorities that Nick's highlighted, that you can focus on to help you move forward, both in the short term, but also in the medium term from here. So James, I will pass over to you.
Thank you, Laura. Thank you, Nick. Morning, everyone. Thank you, everyone, for making the effort to attend. Very much appreciated. I'll just do some brief introductions. My name's James Stephen, and I've got the pleasure of facilitating our panel discussion today. I am a partner in our business restructuring team and head up our Scottish practice. I am joined by David Hopkins, who's a managing director in our restructuring practice, who is one of our retail experts in our restructuring team, and John Strowger, also a managing director in our restructuring team, and John has had a particular focus on the energy sector. And also pleased to introduce Richard Austin, who is a partner and head of our value creation team. I'm not seeing my panel, guys. I've just got myself on the screen.
I can see myself, James.
Right. Okay, David. Oh, fine. Thank you. Good. Yeah, just without going over old ground, just my own observations when I sat down last Wednesday to prepare for this. I didn't expect to be sitting here today with a tanked pound, the Bank of England and the IMF being openly critical of the government, none of which suggests to me that it's helping with consumer confidence. So, David, turning to you first, with consumer confidence not great, what do you see as the headwinds that are really facing the retail sector as we sit today?
Thank you, James. Good morning. So, as Sophie and Nick have just mentioned, it's certainly been a challenging time for UK retail over the last few years. And just looking at the events of the last few days, it's certainly likely there's going to be many more challenges ahead. I think the main issues UK retail has been faced with surround a number of key areas. There's been supply chain issues. As Nick mentioned, the price and availability of shipping containers has led to many stocking issues. As you just said, James, is the weakness in the sterling. It's obviously particularly relevant to importers at the moment. In addition, it's been particularly difficult to recruit and retain staff. There's the big issue of changing consumer habits. For example, the Monday to Friday working week is now appears to be moving to a Tuesday to Thursday working week, obviously affecting footfall in city centres. There's inflation and the cost of living crisis, certainly making consumers think twice before any discretionary spends. Sophie mentioned earlier how homewares and larger ticket items are being hit particularly hard. There's the rising interest rates, which will obviously lead to a rise in debt service costs. ESG and sustainability is an ever-increasing area of focus, I think, for UK retail as well as everyone, and that comes with its own set of challenges and costs potentially. And when you factor all those things in, you've got working capital management, which is ever more challenging. And last but certainly not least, you've got the rising cost of energy, which is going to affect us all.
Thank you, David. Just turning to the energy point, we've got John with us, who, as I say, has spent quite a bit of time focusing on the energy sector within restructuring. And John, you're going to lift the fog for all of us, aren't you? You're going to explain to me why my bill that drops through my door from Scottish Power every month seems to only be going one way. So, John, just as a kind of general kind of comment, what's happened, John? What's happened in the energy sector?
Thank you, James, and good morning, everybody. And sitting here listening to all this, apologies, I'm not about to pour all the good news out. I'm afraid we're probably going to focus on the negatives for a moment, and then have a whip round for James and his energy bill. So look, there's been plenty of column inches dedicated to the energy crisis of late. I think it's still worth revisiting exactly what the causes are, because actually it's hit the news lately, but really this has been going on for 18 months or more. I've been waking up and reading the energy news and depressing myself on that, and then cheering myself up by coming to work. So what's been happening? Well, there's been a smorgasbord of things that have been hitting the energy sector over the last 18 months or so. Sort of the big three, if you like. Number one at the top is quite clearly what's happening with on the supply side with Russia curtailing and drastically reducing the level of supply into Europe, which in turn has led to quite valid concerns among the likes of Germany and the Netherlands, who rely massively on Russian gas for their supplies, to boost their stockpiles ahead of winter. So that led to a huge demand increase of alternative sources of gas, of LNG, from around the world. And so, being a global price, that's pushed all the prices up for gas globally. You've then got other impacts. So the French nuclear fleet of power stations has been taken offline at various points, and output was reduced. Now, France is a big exporter of power around Europe. At certain points, it was importing power. That's how drastic the reduction in their generation capacity was. And that means other countries have turned to alternative source of supply, i.e. firing up the old gas-fired power station. So incremental increase in supply demand. And then adding to that, you have the climate events. So Norway, China, other regions are quite big on hydro for energy generation. The droughts, I'm not allowed to turn my hose pipe on at home, but so there are droughts not just in southeast London, but obviously across Europe and globe, has led to reduced hydro availability, and again, so more burning fossil fuels, more demand for energy. So actually, we saw basically mad prices over the summer, sort of 10 times plus being the sort of historic norms. And so that's filtered through into the consumer base, obviously. So we're hearing the sort of horror stories of businesses going to renew their energy supply contracts and being hit with offers of 6, 7, 8, sometimes 10 times what they've been paying previously, plus demands for huge security deposits, because the energy supply companies themselves are worried about credit risk. They're worried about their own credit risk. I speak quite a bit with TPIs and brokers in the market, and they're saying that for a period of time, energy suppliers simply weren't offering deals to particular sectors because of the risk that goes with it. Now, prices have fallen back a little bit, largely due to stocks of gas in Europe being filled up, but they remain high, and structurally those issues remain, which have created the volatility of late.
Thank you, John. And two questions, and one really: do you think the government intervention is going to work, and is it long enough? And in the context of all you just told us, what can the retailers do to address this, what effectively is an energy crisis?
Okay, so taking them each in turn, I guess the government was left, has been backed into a corner of a not particularly palatable option of essentially widespread failures, or essentially taking the biggest energy short position in history of underwriting the cost of energy for businesses and consumers. The energy bill relief scheme that was announced for business, there's still some details we put around it, and it's relatively complex, but broad brush, the actions they've had to take is to guarantee, if you're on a fixed tariff, a guaranteed unit rate, which pen's handy for electricity is at 211 pounds a megawatt hour, and gas is 75 pounds a megawatt hour. Now that compares to what the market thinks the prices might be over the next 6 months of north of 600 pounds for electricity and 180 pounds for gas. So they're taking a big lump of the pressure off there. But as I say, it's only for 6 months. And if you're on a variable or a default deal, so if you are looking at your contract thinking, well, I'll just drop onto a default and hope things sort themselves out, there are limits to how much the government will pick up the tab there. So tip number one is get all over what your energy contract is, and when it comes up for renewal. But at least what the government's done, it can allow energy supply companies to actually be offering deals again, which is a positive. Albeit, as I say, only a 6-month period, and there will be a review after 3 months to make sure that support is being channeled into the right parts of the economy. Because I don't think I'm speaking out of turn by saying I'm not entirely sure UK government can afford to prop up the energy costs of the entire economy for particularly long periods. I think we will see some curtailment come April. Now, on to what should we do about it? Well, I think going back to the structural issues, I don't think we can pretend that this is over the next 6 months going to sort itself out. We're going to wake up on the 1st of April next year and energy prices back to their old levels. I mean, unfortunately, I think we're here in a high price environment. I would put my neck on the line and say for a number of years. The volatility issues, unless there is a supply resolution around supply from Russia, I see that as soon as Europe starts to fill its boots again after depleting its reserves, that's going to cause more pressure in the markets, another spike in prices, especially with the unfortunate events, shall we say, of the explosions that have knocked out Nord Stream 1 and 2. Doesn't look like there's going to be a resolution to the Russia situation in time quickly. So looking at that in the context, you've got 6 months. What should we do about it? Appreciating we've got a smorgasbord of people on the call, but trying to make this as general for everyone. Really, it's starting first off with demand side reduction. Everything's focused on demand side reduction. Start with your easy wins, things that don't affect your customer, don't impact the customer. So that could be something like an energy audit of some properties. If you're a multi-site retailer, this could be a real boon. That there are specialists out there that we engage with who audit a property's energy usage, and that will reveal things like, is the heating being left on, is the air conditioning being left on when the premises are not being, are not filled with customers. So there's an easy win there. Turning the heating down, turning the air conditioning down, it keeps your store comfortable, but saves the pound and pence. Moving into sort of the medium term, that will require some element of capex is investment into low energy lighting, investments if you go into demand side responsive solar panels on the roof to offset usage. If you've got as an example now, some town portfolio with lots of flat roofs, but that's what capex money's tight. There are funders out there who will support these sort of initiatives by picking up the tab at the front end and getting a payback, typically through the savings that are achieved through lower energy bills. And then harking back to what Nick was saying, it's the option, spending that time going options. What happens if the energy prices go nuts here? What does this mean if, with all the maelstrom of other things that are coming down the tracks onto us, is energy going to tip a certain number of my portfolio over the edge? So do I need to be preparing myself for the idea of rationalising the estate, of looking at maybe CVAs or restructuring plans or similar? But then stepping away from all of that, I think we could also recognise that saving energy has got to be a good thing. It's just brought it into focus that why spend more money on energy than you need to? That's good for your bottom line, but it's also very good for your ESG credentials. So I think this is pretty frightening, but also a real opportunity if looked at in the right way. And appreciating what I've sort of thrown there is a lot of talk about the P&Ls of your direct cost in your own P&L, but I think it's also important to be looking over the fence at your key suppliers and understanding what their plans are over the next months in case they get wellied by a large energy bill. And so they pick up the phone with either I'm sorry, we're ceasing to trade, or more likely is trying to push through some significant price rises that you're going to have to try to absorb and then ultimately pass on to your customer. So lots to do, lots to talk about. I could do another session on my own, but I think we'll probably better stop there, James.
Yes, yeah, I'm afraid so, John. Thank you. Some great points there, John. That's really good. David, just picking back up on that then, obviously, John's made a good point about maybe looking at the way your energy is supplied, so sustainability and ESG. What's your message to retailers there in terms of how they should be looking at that from on their portfolio?
Yes, indeed, James. So yeah, sustainability and ESG is an ever increasing area of importance for UK retail and everyone. I firmly believe that organisations that appropriately address ESG as part of their overall business strategy will have a competitive advantage and also mitigate any climate-related risks. It's an area that sees a very high pace of change, and businesses are facing increasing pressures to be ESG compliant. And certainly a business that is perceived to not act appropriately will be increasingly less attractive to customers, investors, and even employees. And as John just mentioned, it extends to considerations in respect of your supply chain as well, making sure they're not undertaking any practices that may affect you in the short to medium term. So, I mean, in summary, ESG is a huge area to cover, and it could be discussed for hours. But and if you're not already doing so, I think most people should be seeking some sort of advice. BDO's financial services advisory practice has a team dedicated to climate change and ESG, and I'm sure we'll be happy to have a conversation and see where they could help out.
Thank you, David. And just very briefly, in terms of all those headwinds that are blowing now and that may blow in the future, what should businesses be doing to mitigate the headwinds that they're facing?
Yeah, very good question. I think as Nick mentioned earlier, it boils down to being proactive. Whatever challenges a business may face, they're usually best dealt with early rather than when it's too late. Look at your financial protections, building sensitivities around key areas. Proper financial planning is often the key to weathering any storm. And again, as Nick said, look at plans B, C, D, E, all the way through to X, Y, and Z at the moment. I think the obvious questions to ask are there any operational efficiencies that can be built in? Can price increases be put in place and passed on to customers? Are there any working capital improvements that you can look to implement to help ease the cash burden? Consider negotiations with your major stakeholders. Is there anything that can be done with your landlords, and looking at restructuring leases, going to turnover-based rent, something, for example? And we do know that HMRC are still very willing to support credible time to pay arrangements at the moment, and that is often a good way of helping working capital when it is needed. And then I'd always recommend speaking to Richard in our value creation services team. He's always got some great ideas.
Thank you, David. Let's bring Richard in now then. Richard, are you there?
I am here. Hi,
Good man. Good man. Richard is going to provide all our solutions, so we're delighted to introduce Richard. So Richard, just as a kind of general observation, obviously with the events of the last couple of years, and particularly last week, consumer confidence is not at its highest. A pound in your pocket is a lot less. What are you seeing that's going to do well? What's the sector, the areas that are looking like they're going to do well? How's it going to polarize itself, Richard?
I think it comes down to I think certain sectors will be under more pressure. I have significant visibility on what's happening in manufacturing, and that includes food and drink. And there'll be some winners and losers in there, I think. Interestingly, I was talking to Pladis a couple of weeks ago, our esteemed manufacturers of McVitie's Jaffa cakes. And they are actually anticipating, usually in a downturn, people move towards affordable treats. They're actually expecting their Jaffa cake consumption to go up. Same goes with Mondelez as well, with the world of Cadbury's. And the other side of it is, I was talking to Coke about a month ago, and obviously they've had some significant changes to their supply chain over the COVID period in terms of channels to market. It's all home consumption rather than clubs and bars, etc. Obviously, in the current environment, they're expecting that to continue as well. So there's a lot of movement going on as well. I mean, just sort of building on that supply chain side of things. Obviously, we've been talking about inflationary pressures across the board. That's going to continue. I mean, the message there from your supply chain is that they are trying to maintain prices where they can, but that is starting to be passed through. And I'm sure a lot of people on this call will be experiencing that at the moment. The question is, how do you manage that from a sort of retailer perspective? How do you understand where value sits? I think Nick was picking up on that earlier as well. I think that's absolutely true. It's absolutely true all the way through to the end consumer. The other thing that we're seeing as well around supply chains is availability of product, which I think we've talked about previously as well. But we're seeing quite a few manufacturers who are starting to reduce their assortments as well, really focusing on the areas where there is higher margin for them. So that obviously has an implication in terms of pricing and shelf planning for anybody who's in the retail sector. The other thing actually to pick up on is, clearly there's going to be a lot of movement over that golden quarter in terms of cash. We talked about it before, but I think we'll pick up on that as well. But obviously there, for things like apparel, there are reverse supply chains as well in terms of returns at the end of the busy season, which can considerably impact cash position as well. So that's one thing that we have seen in similar situations where businesses have really struggled going into the end of sort of January, etc., where cash management is absolutely critical. I think just more broadly in terms of supply chains, the main message that I would have is to stay in constant contact with your suppliers, really having regular ongoing communication, really understanding what their positions are at any one time, and understanding what sort of contractual arrangements you have with them, what levers you can actually pull within those contracts as well if things do change. This is a very fluid situation right now, and making sure that you have the right contractual setups and decision-making processes is going to be absolutely critical. Part of that is sales and operations planning. So that's the bit that combines forecasting through to stock management and to supply chain ordering, etc. Making sure that's as agile as you can possibly make it is going to make a huge impact, both on working capital, but also in terms of profitability and long-term potential growth. So my message there would be, if you don't have good, strong sales and operations planning in place, you really need to start thinking about that now, would be my message on that one.
And what about workforce and labour issues that we hear about, Richard? What's the message that what are you seeing, and what's the message you would give there?
Well, again, I think there's some sort of reflections on what we're seeing in the broader leisure markets at the moment. I think sort of David picked up on it previously, that the working week is very different, footfall is very different, and therefore workforce planning associated with that needs to be suitably flexible and plannable around that. Obviously, minimize resource when you don't need it, make sure that you're being as efficient as you possibly can be when you do need it. The other side that we're also seeing more in the States than anywhere else is the use of technology associated with that as well. Clearly that's a longer term view, but so there are companies like Domino's and Chipotle who are in the US are using AI to anticipate people's ordering patterns before they actually turn up to the store. There are very clever bits of technology that can be put in place. The reality of being able to put those in place between now and Christmas is probably a little bit optimistic, I think. Is it worth sort of touching on working capital? As I think,
Yes. Yep.
One thing around that is, I think Laura's absolutely spot on. Cash is king at the moment. Being able to predict cash position is going to be absolutely critical. There will be big swings, as there always are over that golden period, but being able to understand what levers you can pull at any particular time associated with working capital is going to be absolutely critical. And that's everything from your order to cash processes, purchase to pay, forecast to fulfill, making sure those are as efficient and don't have any log jams in them is going to be absolutely key. The other thing is, it kind of goes back to being able to prepare and anticipate rather than react to things, is we do recommend that people start looking at the 13-week cash flow predictions as well, really managing cash associated with that. And that kind of goes also back to your supply chain as well, really understanding which suppliers are critical to you, which ones are less critical to you, and if needs be, if the kind of hammer comes down, which suppliers you can afford to potentially push out payment terms on as well. So that there are levers you can use. The main message there is really anticipate it as soon as you possibly can. Plan for it now. I think that complete A to Z process is absolutely spot on as well. There will be other things that will happen. I think one thing we're comfortable with is that everything's unpredictable right now. But understanding quickly what the implications are for you and what levers you can pull as quickly as possible is the name of the game. That's will sort out the winners from the less so winners. Let's put it that way.
Thank you, Richard. Thank you, David. Thank you, John. I think we've run out of time. Fascinating discussion. I think we could have gone on for probably 2 or 3 days on all the subjects, but I'm going to pass back to Laura now, who is going to lead the Q&A session. So thank you, everyone.
Thank you all. Thank you, James. So I'm going to invite everyone to turn their cameras back on. I appreciate that we are nearly time, but I think we've got a little bit of time for a few questions. And Nick, we do actually have a question for you, so I'm going to pose it to you first. Someone's asked us about the Santander Navigator that they've seen advertised widely. You know, what is it that you guys are up to?
Thanks for the question and the opportunity for a shameless plug for something that, yes, we have tried to advertise quite heavily and put it into the market. And I think this is Santander really kind of trying to get across to the market where we can add a difference or make a difference. Effectively, Santander Navigator is an end-to-end subscription model that we've launched, focused on companies that have international aspirations or are looking to develop international trade. It helps identify different markets. So, you know, if you have a choice between various markets, kind of which one may have a larger market share, how is that broken down, and also how to navigate the various country regulations and red tape entering into those or trading in those countries. I mean, ultimately, it's there to drive connections and more business and international trade between companies. I think over the next month or so, we have an event for launching retail operations in China. We have a buyer event with Portuguese and Spanish supermarkets and a pharmaceutical event, I believe, in Poland. So all of these can be accessed. You know, feel free, reach out to me via LinkedIn or contact director at Santander for more details. But yeah, the portal, you know, really it is to encourage international trade, and I guess other features that we're developing and are in place at the moment, such as discounted shipping rates, where we're just leveraging our presence, you know, in the market and being able to pass those discounts on to our clients and prospects. Thanks, Nick.
And another question that we've had in, which actually was the question I was keen to pose to the panelists. Nick, you talked about consumer experience, that brand engagement, everything that goes with it, and then, you know, our last session debated, you know, some of those challenges of having bricks and mortar retail. Sophie, I'm going to go to you first. How can retailers really balance the customer experience and what is an increasing cost of having the infrastructure that traditional retailers had? What do you see that people can think about, what people should be thinking to do from here?
Yeah, and this really does lend to what Nick was saying earlier. Actually, it's not just about giving the consumer value in terms of the product, but value your consumer. And we know that the bricks and mortar channel is the one that you can engage the most with. And I guess what we mustn't forget is that, and maybe this is one for a future session, is that actually selling online is very expensive. And we can see that in the margins that online retailers compared to the margins of selling in store. So I think the key thing about having a physical footprint is making sure that you're using that across your business. It's valuing your consumer, how you engage in your store, but using that bricks and mortar structure to also drive the consumer across your channels, using it as much as possible to really drive the returns and understanding the overall cost of it. But it's not a channel which is going to disappear. It's definitely going to be there. And we've seen that with other retailers going into bricks and mortar because of the importance of that channel. So it's just really driving it to get the best return you can.
And Tom, anything to add from, you and I have talked about sort of what's happening in markets, what's happening in consumer engagement. Any thoughts just to add to that point?
I think that people can start to evaluate, I guess, the playoff between the staff influencing the customer experience and the store working to describe and embrace what that customer experience is about. So, for example, the virtual world that people are on today and shopping, the content that's out there is free for these brands to use. How can they bring that into store to tell the narrative about what consumers are saying about the brand and how they're thinking? But equally, if you are having to staff stores in the way that we know you have to create the right customer service, well, how are we training those people to build on that on that customer relationship, to engage with them, not just to sell product? So I think with the assets you own and the budgets you have to pay for those assets, be it digital displays or staff, really understanding what the best use of their time and the training that goes into those is going to be important.
Amazing. Thanks, guys. And I guess one final question, appreciating we've only got a couple of minutes left of today's session. Nick again pointed to when you're looking to export and internationalization, figuring out where you start. And Neil, from a tax perspective, we know there are some big pitfalls of international trading. Any quick tips we can share with the audience of just a few takeaways as they think about opportunity outside of the UK while things perhaps settle down here?
Quick tips. I mean, we could probably do a whole webinar on it, Laura, and maybe we should. I think is don't rush into it, and I think that echoes what Nick said. Think about your approach, your strategy, your structure, and how you're going to operate in a particular market. Look at the margins that you're looking to achieve. There's lots of processes and challenges and pitfalls that you need to work through, as we touched on in the last webinar. Things like customs duty, getting all your shipping and logistics right for a particular territory. So don't rush, plan carefully, and think about it. I think in the current climate, given where the pound is and exports being relatively cheaper, if you can look at existing channels into particular markets and just think about the mix between UK and those existing channels, and can you do a bit more, that's probably the safest way at the moment. I wouldn't be advising with the current volatility, go on a massive investment spree and try out some brand new markets, but I think there are some incremental gains that you could probably take. And when we've got a bit more detail about the return for VAT-free shopping for overseas visitors, I think again appealing to that audience and looking for incremental gains that you can take there, particularly in the West End, or if you're operating in Bicester Village, I think there could be some opportunities for margin protection there as well.
Brilliant. And whilst I have a lot more questions for my panelists, I'm always conscious of time of our audience. So I'm going to end it there and say my thank yous to everyone who's joined us today, all of the panelists, in particular Nick, who's joined us from Santander. As I mentioned briefly, we are in the process now of doing our retail trading forecast, which is our annual publication. And what we've decided to do is to give you a few insights in our next webinar, which Sophie will lead. So on the Thursday, the 8th of December, we will be just touching on some of those topics, and we'd be delighted if any of the audience would love to join us. The invites will be out ahead of that event. But thank you again, everyone, for your time. Thank you to the audience, and we look forward to seeing you on the 8th of December.